What do you see exactly in the following headlines? People like Alex Becker would say, "I see an opportunity." But upon closer analysis, only one thing transpires here: control. The cryptocurrency market is undergoing a fundamental paradigm shift. The era of retail-driven, easy-to-predict, sentiment-based cycles is no more, replaced by a more complex and institutionally influenced market. This transition is not an accident. It is the result of a deliberate, multifaceted, institutional adoption. So the question is, where does it lead us? First, there is the institutionalization of market infrastructure. The approval of spot Bitcoin ETFs in the US represents more than just a new investment product. It signifies the construction of regulated industrial-grade market plumbing. As of late October 2025, these ETFs have accumulated over $149 billion in assets under management, creating a consistent structural demand for the underlying asset. This is supported by the maturation of custody solutions, such as Coinbase Prime and Anchorage Digital, and the growth of regulated derivatives on the Chicago Mercantile Exchange. These are the tools that allow multi-trillion-dollar asset managers to operate at scale, with the same risk management and compliance standards they apply to traditional assets. Second, the tokenization of real-world assets, or RWAs. The most significant long-term trend is not crypto replacing traditional finance, but traditional finance migrating onto blockchain rails. RWA tokenization is the process of creating a digital representation of a physical or financial asset on a blockchain. Think of it as digitizing the world's illiquid assets: a commercial real estate building, a private equity fund, or a government bond can be converted into a programmable, fractional, and globally tradable digital token. The Boston Consulting Group projects that the market for tokenized illiquid assets will reach $16 trillion by 2030. This is not a niche market. It is the digitization of the global economy. Institutions are not merely buying crypto, they are building the infrastructure to tokenize everything else. Third, the formalization of regulatory frameworks. Governments are no longer debating whether to regulate crypto. They are implementing comprehensive legal structures. Europe's Markets in Crypto Assets, or MiCA, provides a clear rulebook for issuers and exchanges. Similar frameworks are being debated in the US and Asia. This regulation is a double-edged sword. It provides legitimacy and attracts conservative capital. However, it also creates a regulatory moat, a walled garden where only licensed, compliant institutions can operate. This bifurcates the market between the regulated and the permissionless. Given this analysis of the current market structure, what are the most probable outcomes over the next decade? The data points not to a single future, but to the emergence of three distinct, parallel layers of the digital asset economy. The first and largest layer will be the institutional layer. This is not a future projection. The software for this new world is already being deployed by the largest financial institutions on Earth. JP Morgan's Connexus platform, BlackRock's BUIDL built on the Ethereum blockchain, Goldman Sachs' GSDApp platform, just to name a few. And underpinning it all, custodian giants like BNY Mellon are building the digital vaults, the custody platforms required to hold and secure these trillions in new tokenized assets. These are not isolated experiments. This is the coordinated construction of a new financial architecture, a highly efficient, 24/7 global market for tokenized RWAs, where an asset that once took weeks and teams of lawyers to transfer can now be settled in minutes, with compliance rules encoded directly into the token. So if institutions control the assets with such efficiency, what role does the state play in this new digital economy? This leads to the second layer, the state layer, dominated by Central Bank Digital Currencies, or CBDCs. The tokenization of assets necessitates a native digital currency for settlement. Governments will not cede this function to private stablecoins or decentralized cryptocurrencies. The Atlantic Council reports that over 130 countries, representing 98% of global GDP, are now developing a CBDC. A CBDC is fundamentally different from cryptocurrency. It is a direct liability of the central bank, recorded on a centralized, permissioned ledger. Its key feature is programmability. This would enable new monetary policy tools, such as the direct-to-citizen distribution of stimulus or the implementation of negative interest rates. It also introduces the technical capacity for unprecedented financial surveillance and control. Finally, the third layer, the sovereign layer. In a world of institutional RWAs and state-controlled CBDCs, Bitcoin's value proposition becomes clearer. Bitcoin's original idea was a work of anarchic genius, created in direct response to the 2008 crashes, an asset to counter traditional systems prone to corruption. In consequence, its function will not be to compete as a medium of exchange for daily transactions, but to serve as a non-sovereign, censorship-resistant store of value. It is a global, apolitical monetary asset, secured by a vast, decentralized expenditure of energy. The network security hash rate now exceeds 600 exahashes per second, a level of computational power that makes it the most secure computer network in human history. Actually, the Bitcoin security is now so immense, the sheer cost to challenge the network would require a capital investment so large, it would be like trying to buy every single NFL, NBA, and Premier League team all at once. This economic fortress makes it the most secure computer network in human history. In this future, Bitcoin's initial philosophy gets amplified and acts as a monetary insurance policy, becoming a final exit from the permissioned, state-controlled layers of the digital economy, a neutral settlement network for large transactions that must remain outside the control of any single entity. In conclusion, the next decade of crypto will not be a story of replacement, but of parallel systems. The vast majority of financial activity will migrate to the institutional and state layers, leveraging blockchain for efficiency and control. Simultaneously, the sovereign layer, led by Bitcoin, will solidify its role as the ultimate digital bearer asset. The future of money is not one network, but a choice between fundamentally different architectures of value and control.